Okay, so now we go to debt funds. So now you just go to debt funds under the money control. Okay, fine. So before we go there, just have a look of how the funds have given, returns have given, okay, for all the equity funds. So this is the 3-year returns of all the top performing funds, okay, just a month back. Large cap, Nippon has given a 3-year consolidated return of 31%, okay. And large and mid cap category, SDFC mid and large cap has given 32.73. Whereas mid cap fund, the best is Quant mid cap, which is given 40%. And small cap fund is given 47. Okay. So these are the, the funds, and the average is around, maybe just 17, 18, 19% average for large cap. So these are the top performing funds. I've shared the PPT. आपके पास PPT आ गई है? Okay. Just go to your WhatsApp. It is there. Okay. So these are the funds. Okay. Now let's go to the this table. So here what I have done, debt funds. So ये बड़ा important है for all of you, because 50% money or maybe 40% or whatever, I mean it's your risk profile, you should be putting at least 50% money in these funds, 50% in equity. Of course, I put 60% equity, 40% in debt. Okay, fine. हाँ जी, 120 minus age, the new formula. So 120 minus age should be in equity. 120 minus, suppose you're 60, you're not. So 120 minus 60, that means 60. 60% should be equity, 40% should be debt. No, this is the new norm. Okay. So, just to show you, in last 1 year, my return from the stock market is close to about 50 lakhs. 1 year return in all mutual funds. Okay. अभी देखेंगे अभी देखेंगे. Okay. कोई बात नहीं. It's saying 50 lakh rupees a return in last 1 year. Okay. Okay. हाँ अभी दिखाऊंगा, दोबारा दिखाता हूँ. पहले जो मेन चीज है वो देख लेते हैं. वो तो मेरी रिटर्न है. नहीं, it was, that was about 4 years back, and I have not updated my portfolio. It's about 5 crores, which is a million. So this figure is around about 60 to 70 lakh rupees per annum I am earning from mutual funds or equity. I am not pulling it out. I am converting my debt into equity now. That is what I am. Earlier I had 60% debt, 40. Now I made it 60% equity, 40% equity. Okay. Now the more important was the debt funds. Okay, please focus. This is a very important, kind of a thing. Otherwise, time is running out. आपको main चीज पता नहीं चलेगी. Okay. Please ask questions, but first listen carefully. सुनते जाओ, ज़्यादा होगा अच्छा रहेगा. It's getting recorded. Okay. So there are about lot of funds are there into debt funds. Low duration, long duration, short duration, and a lot of duration. Word duration has been used. Okay. Do you know what is duration? No, हाँ time तो होता है, but duration is no. I'll just tell you. There is a concept called duration. Like there is a concept called beta in stock market. There is a duration which captures the risk of the fund. The higher the duration, more risky is that bond fund. जो ज़्यादा long duration होगा, that will give you a very good return also, but it will come with a lot of risk. Okay, but it is not advisable to invest most of the time in long duration unless you have a good, kind of a call that interest rates are going to come down heavily. Okay, I'm just going to talk about. Let's start that. Okay, so so let's look at but still these funds don't give higher returns as compared to equity. There is no comparison, but your portfolio should have all these funds. or any of these funds. So first one is called the overnight fund. Okay, that's one category under debt fund, where Mirai Asset is giving 6.5% return over the last 3 years. Okay, 1 year. Sorry, this is 1 year return. इसमें 3 साल का निकालने की जरूरत नहीं, 1 साल का काफी होता है. It's a debt fund. Okay. Now overnight means that the fund manager is investing into those instruments where, like, State Bank of India needs money for just 1 day. So it may go to either RBI or may go to, say, HDFC Bank and say, I need money for 1 day. So they keep borrowing, for overnight period or 1 day or 2 day or overnight. So these are called overnight funds. Right? So all these fund managers, or even the fund manager is also giving funds to these banks or these financial institutions for overnight. Okay, and they are earning 6.5%. Of course, it's way below the current fixed deposit rate, isn't it? So you'll not like to put money in this thing. Next is called the liquid funds. Okay, it's 7.06. Earlier, you could have, withdrawn this money. You could have put today and withdrawn next day. It will give you 7% return. अभी क्या होगा, इसमें exit load हो गया थोड़ा सा, so the return drops a bit. We were using this when I was working in Idea Selva. So we used to have our postpaid customers all across the country. Okay, so every day some postpaid customers were paying. So all that money was coming through all the banking channels. Like suppose in place like Chhindwara in Madhya Pradesh, somebody gives the money to State Bank there or Punjab National Bank there, or somebody in Bombay, postpaid customer, he deposits the money in, say, ICICI Bank. So all that money will get pooled and come to our head office. So in our head office account, maintained with, say, for example, HDFC Bank or Standard Chartered Bank. So from all, places, about, so many villages, so many towns, so many cities, I mean, maybe 20,000 places, all the money will get, consolidated at one place. Okay, this scheme was called CMS scheme, which was just launched that time when we started this. And every day by 5 o'clock, all the money which was collected, any nook and corner of India, will get collected there. So it may be like, like 100 crores or 50 crores or 70 crores like this. Maybe I don't remember exactly. So the treasury manager, who was the vice president, he was monitoring this account. He used to put all the money, he was making a forecast. How much is the money which is required by each our business unit and how much money is spare with us. He was doing a planning, day-wise day planning. So he knew that, some money is lying idle, which is lying in current account. So he will immediately put that money in liquid account, fund. And after 3 days, he'll pull out that money. So he was getting 7% return, which was a huge amount. Suppose on average, 100 crores was parked. So he used to give 7 crore rupees or maybe more, maybe I think around 15 to 20 crores he used to earn by that treasury management. Okay. So, but now most of the corporates are doing it, but now there is some kind of an exit load, which is, 0.05%. So some kind of a return has been slashed from there. If you exit, say, after a week, maybe after a week you exit, you will get some hit. Even after 2 weeks, some little bit more, less hit. Maybe after 1 month, there is no exit load. Okay. So now if you have money for 1 month, you will get a full return. Okay. Fine. Now there's something called low duration fund. Now these low duration funds are actually competitors of fixed deposit. Instead of putting money in a fixed deposit, you put money in low duration funds. Okay. Low duration funds are investing into all, high class paper, all AAA, AA, all AAA rating, rated companies in India, like Reliance, Infosys, TCS. I mean, name all the big companies. So all the money is basically they are putting into into these places, and they are giving a consolidated return of about 7%, 7.76%, which is close to the FD kind of a thing. Okay. Now, no, they are variable. They keep changing. They keep changing. I'll just take you through. I'm just giving you some idea, and then we'll go and understand the specifics, how the returns can be volatile and something like that. So it gives you about 7.76%. It will always track a fixed deposit return. Okay, fine. Sometimes it may be giving less on the face of it. Okay, but fixed deposit to take 1 year, so you are going to get return after 1 year. How much? 7.5%, isn't it? Suppose आपने 1 साल की FD ली तो आपको 7.5% 1 साल का मिलेगा. ये जो रिटर्न है आपको करंट मिल रही है. Maybe this return maybe was 6%, but people were thinking this giving 6%, so it is not good. Let me put my money in fixed deposit. That's not correct. There is another thing which you see, how much return this will give 1 year down the line. So you can even calculate that. So if it comes to 7.5%, then it is better than a fixed deposit. Now earlier, before 31st of March this year, whenever you sell mutual funds, which are debt funds, you are entitled for indexation benefit. Okay, which I told you in the capital gains. So, so that means if there is a 6% inflation and it is giving you 7%, only 1% will be taxable to you. Whereas in fixed deposit, entire 7% is taxable. So the banks, they were lobbying against this thing that nobody is depositing money and everybody is putting in low duration, so they are losing customers. So this 31st of March, the law has changed. There will be no indexation benefit from this year. So they stand now at par with the fixed deposit. But the only thing is, if whenever you sell, it will be taxed. If you don't sell, you remain invested for 3, 5, 10 years. Suppose you have a portfolio where 70% is in equity and 30% in debt, and you don't want to take it out, for example. Then it makes sense to put the money here. You're getting 7%, no tax, no TDS. Like a bank deposit, some TDS will be deducted every year based on how much they have credited to your account. Okay, how much is the cumulative balance? Suppose you have taken a 5-year fixed deposit, so every year there will be some kind of a tax deduction happening. Here there will be no tax deduction. Okay, so that's an advantage. हाँ जी, हाँ मैं बताऊँ. टाइम आप तो इन्वेस्ट करके भूल जाओ लो ड्यूरेशन में, तो हमेशा आपका पैसा लो ड्यूरेशन में ही लगा रहेगा. ओके, यू डोंट बॉदर कितने साल का है कितने का है. ओके, so low duration is giving 7.76. So income tax में you have to pay tax only when you sell. Fixed deposit, you are taxed every year, but of course the tax rates are same. It is as per your slab. Okay, fine. And maybe take out the money when you ultimately retire and you don't have any other income. So that means your slab may fall down and you have to pay less. So there are a lot of advantages you can think about putting your money here. Okay. Then there is something called short duration, 7.7, ultra short duration, medium to long duration. As we are going up, the returns are going up. Okay. Okay, fine. Look at the the long duration. It is giving 8.65. Okay, but it's riskier. Now, at that time when I captured these return, the interest rates were coming down in India. When the interest rates comes down, these funds start giving a higher return. When the interest rates, fall, these funds gives you more. When the interest rates start rising, these funds negatively perform. Fine. When the interest rates I say is basically, we look at the government bond rate. Okay, because ultimately all interest rates are okay, loan rate, everything is okay, deposit rate, fixed deposit, that's all interest rate. But the main interest rate which actually propels all other rate is the government 10-year bond or any bond of the government. Okay, fine. Government bond this time 7.3% return de raha, 10-year bond. So that is the gateway of interest. All other interest rate will be derived from there only. If government is giving you 7.3%, banks will give you 7.5% return. Because government and banks are almost same, they're same kind of a risk, but government is least risky. Banks can fail. Okay, so they'll give you a little higher. A AAA company will give you 8.5% because they have to give more because they are riskier. Because when you are investing in a bank, in a company, you assume more risk. But suppose you give a money to, say, for example, Reliance Industries or to a bank, you always think bank is more, less riskier. And Reliance is, Reliance is not going to fail. It's such a big business, but still give you around 8.5%. Okay. Now go to a company like DLF, it will give you 9.5%. Or Sundaram Finance will give you about 10% because they have lower rating. Fine. If the government bond rate comes to 6%, all other interest rates will also come down. All other interest rates are pegged to the government bond rate because that is the central rate. That's a risk-free rate. Without any risk, you are putting your money. That's a rate which is currently hovering around 7. I'll take you to a site which tells you about that rate. There's a graph there. So 7.3% keep changing. Okay, fine. So because this time the interest rate has shown some kind of a decline. Okay, because there is a decline, these funds started performing better. Okay, but in case if the interest rates start rising, then these funds will give you a very far lower return, 2%, 1%, 3%, or even negative return also, long duration return, and I'll show you that. Okay, then there is a last category which is called The credit risk fund. Credit risk fund is basically they are putting money into companies which are double A, single A, not triple A. Now, DLF may be a single A company. If you look at a bond rate of DLF, suppose there is a bond, suppose they are saying that we are accepting money from the public, they are giving you 9.5% return. Okay, Reliance may be giving you 8%. So you would be thinking I'll put money in Reliance because it's safer, but you get 9.5% if you put money in DLF. So they are putting money into those papers which are either double A or single A up to that level. Okay, so the returns are 9.12. In bad times, there was a company which failed. Like Vodafone Idea was in big trouble. So that fund, there was some negative return in that year. Or there was some fund company called IIFL or something. There was a collapse of one of the NBFC. Hanji? Haan, IIFL. Haan. So that collapsed. Okay. So, I mean, a lot of money was put in these funds. So people lost a lot of money in that funds. Okay. But now the government has become very strict. So they have, everything has become quite clean, but of course surprises can always occur. Okay, so a credit risk fund can give you 9% return also. This SBI credit risk is a fund. They can be HDFC credit risk. They can be ICICI credit risk. Okay, fine. Yeah. हाँ लिक्विड फंड आपके पास 1 महीने का पैसा है लिक्विड फंड में डाल दीजिए इट विल गिव यू 7% यू फाइंड दैट एफडी इज आल्सो गिविंग यू बट आप टेक्स्ट में तो सेम हो जाएगा बिकॉज यू आर पुटिंग इट ओनली फॉर अ मंथ या या है है नहीं अभी अभी आई एम जस्ट शोइंग यू so these are the funds so similarly you can go to liquid fund for example you wanted to know liquid fund हाँ ये okay so it will give you all the list of liquid funds fine so look at 1 year return here I'm just telling you, just park your question at the while. So this is giving you 1 year at the moment of 7.16. Okay, fine. And look at a low duration. So I always put my money in low duration, unless I have a clear visibility of the interest rates. Low duration. नहीं अगर लिक्विड हम लोगों के लिए तो लिक्विड लो ड्यूरेशन इज बेटर बिकॉज लो ड्यूरेशन विल गिव यू हायर रिटर्न ना लिक्विड में कितना दिया 7.16 अब लो ड्यूरेशन चलते हैं सो लो ड्यूरेशन 1 year so 7.62 fine of course it can give you various it can go down to 7.147% also so it's 7.62 so if you don't have any knowledge nothing so park your money in low duration funds if you don't have any other this thing put your money in low duration acha just listen I'm just going to talk about something more important there's something called YTM here is written YTM isn't it this is called yield to maturity now because this is a low duration fund I'll just show you first of all okay so this is the chart लो ड्यूरेशन फंड 6 to 12 months ऊपर लिखा है मकाले ड्यूरेशन है सो दिस ड्यूरेशन का फुल फॉर्म है मकाले ड्यूरेशन उसमें लिखा भी हुआ है आपके मनी कंट्रोल में मकाले ड्यूरेशन आई एम गोइंग टू एक्सप्लेन व्हाट इज मकाले ड्यूरेशन दैट्स अ वेरी इंपॉर्टेंट कंसेप्ट सो लो ड्यूरेशन मींस ऑल द इंस्ट्रूमेंट्स आर where they have invested are between 6 to 12 months so that means if they have put money they'll get back the money in 6 months time and they are going to reinvest either ranging between 6 to 12 months paper they are going to invest okay and they are going to reinvest always in that duration band it's called low duration okay now let's go back to this site again and look at YTM here okay so YTM is the return if you hold the bond say for 1 year then you are going to get 7.79% return 90% chance is that you're going to get this return. Okay? Because the paper they are holding, they have bought it, and the return till maturity, that means till maturity, if they hold that paper, they are going to get 7.7. This is the average return of all the paper. Because, they have invested in, say, 100 bonds or 100 securities. तो इसका एवरेज है ये. अभी बता रहा है 7.62, बट ये 7.79 पे क्लोज होगा एक साल के अंदर. आप जाओगे तो यहां तक पहुंच जाएगा. अब आज आप पैसा लगाओगे तो आपको 7.79% रिटर्न मिलेगी. दिस इज द रिटर्न. इट टेल्स यू द फ्यूचर रिटर्न ऑफ 1 year or close between 6 to 1 year, because the fund paper is duration paper is 6 to 12. So all the fund, it is all the securities is holding, they'll get matured in 6 to 12, unless the fund manager sells. I mean, he does something foolish, he sells these fund before the maturity, then your return can get affected. The fund manager is not going to do that. हाँ हाँ, वो मिल जाएगा, कम हो जाएगी रिटर्न आपकी. जो अभी दिखा रहा है उतनी हो जाएगी, 7.62 हो जाएगी as against 7.79. Is that okay? Yield to maturity. Is that okay? Now, हाँ बाबू, अब हाँ, अब ये देखो, आप ये देखो, एक साल 2 साल की रिटर्न कितनी है? 5.9%. हाँ, वो वही था. आज से 2 साल पहले ये रिटर्न 5% भी दे रहा था, बट YTM was 7.7%. हाँ, मैं बताता हूँ आपको, ये डिपेंड करता है इंटरेस्ट रेट के ऊपर. मैं अभी वहीं जा रहा हूँ, अभी आपको वहीं ले जा रहा हूँ. Please, now we are going to explain. This is a best concept. You must understand this concept if you really want to know it. Okay, fine. So I'm just opening an Excel sheet. I have just shared an Excel sheet which is called bond YTM, and ये फाइल आप खोल सकते हो तो खोल लो. Okay. Since I'm not going to explain you everything, it's a long topic, so I'm just going to just go to the right place. So please focus here, sir. Everyone. Now think about now 20 year, 10 years, 5 years, 3 years, 2 years, 1 year. So these are all bonds. ये मैंने अभी शेयर कर दी ना सर. एक्सेल शीट मिल गई होगी आप. ये आप हैंडी कर लो, बड़ा इंपॉर्टेंट है, इसको खोल लो आप, बिकॉज यू कैन प्ले विद अलोंग विद मी इफ यू वांट. नहीं तो आप देखो. सो इसमें क्या है, फर्स्ट इज 20 year bond. नाउ गवर्नमेंट और एनी कंपनी कैन इशू अ बॉन्ड फॉर 20 years. भाई 20 साल के लिए आपसे पैसा ले लिया, आफ्टर 20 years they are going to pay you money. Suppose they are paying 9%. Coupon rate is 9%. So any bond will have a face value and a coupon rate and maturity period. Okay, fine. So इसका maturity period कितना है? 20 साल. Coupon face value कितनी? 100. And what is the the coupon rate? 9%. Okay. So I have shown you 100 rupees you are investing minus. You give 100 rupees to the company, they are going to give you 9999 every year, and in the 20th year they are going to give you 109. Is that okay? Is it clear? Now take this 10 year. In 10 year, in the 10th year you're going to get 109. That's the only difference. In 5 year you're going to get, in the 5th year you're going to 109. Is that okay? And in the 3 year, same, 2 year like this. ये समझ में आ गया? Okay, fine. Is that clear? Now just go to the 20-year tab here. Okay, look at 9%. 9% में the face value is 100. You know that here put 100 rupees, you're getting 9. Now suppose the rate of interest comes down to 8%. Now ये fund, ये bond तो आपको 9% return देगा ही देगा. Nothing is going to happen to this. But the bond price in the market will go up to 109. Why? Because if now suppose you have invested, please listen carefully. If you are invested in a 9% bond for 20 years, after 1 year, for example, the interest rates have come down to 8% because interest rates keep changing. Okay. Now, if you go and check now, the same company is issuing bond at 8% now instead of 9%. But whatever bond you have bought at 9%, for 20 years, you're going to 9. It's not going to affect that. But if you buy a new bond, you're going to get 8%. Now, investors have two choices. Either to buy a new bond from the company at 8% or can go to the market stock market and buy this bond at 9% coupon rate. But the coupon rate 9% bond will be in demand because it will give you 9%, isn't it? So when you go to the market, the bond will find is selling close to about 109 rupee 82 paisa. It has appreciated by 9.82% because the interest rates have come down by 8. This is the critical price. Okay. Maybe the bond will be at 109 or 108 or 107 or 110. If it is 110, don't buy because you will get less interest yield. Okay. So here you are getting now 8% return. If you buy this bond at 109 now from the market, suppose you buy it for 109, what is the return you are going to get? 8%. Because you are going to pay 9 rupees 82 paisa extra to buy this bond. Unless you buy it at 107, it is worthwhile. Or 108 is worthwhile because then you are getting a return a little higher than 8%. Okay. अगर ये 109 पे पहुंच गया, so then there is no fun in buying this bond. Go and buy a bond either from the primary market, from the company itself, or from the stock market. It's not going to give you any difference. Have you followed this? So when the interest rates comes down, the bond prices go up. Here, the interest rates have come down by 1%, the bond prices have gone by 10%. If the bond is 20 years old, okay? If the bond is 10 years, 9 से 8 आया, तो bond price has gone up by 6.7%. So a 20-year bond is going to give you the highest return if the interest rate drop in the market. So long duration bond, think about, a bond which is 20 year will normally have a long duration. Normally will come in a long duration, but duration is different. I'm going to explain that. So a 10-year bond is going to give you only 6.17% return. So if you had invested in a 10-year bond, you will get 6.7% return along with your coupon rate, which is 9. So 9 plus 6, about 16% return or 15% return, isn't it? और अगर आपने 20% वाले में लगाया हुआ था बॉन्ड में, तो उस साल अगर आप बेच के निकल जाओगे, तब अगर बेच के नहीं निकलोगे तो आपकी रिटर्न तो 9% रहेगी क्योंकि आपको एंड में जाके उतना ही पैसा मिलेगा. If you hold the bond till maturity and don't sell it, these prices are not going to make any difference to yourself. Okay. But suppose you invested for 1 year and the bond interest rate came down to 8%, you can just sell the bond, earn 9.28% capital appreciation along with 9% coupon. Suppose on the 365 day you sold the bond, you are entitled for 9% coupon rate, the company, plus this 9.5, 9.82. You are getting how much? 9 plus 9, 18, 18, 19. So your long duration bond will give you 19% return. If you look at long duration bond, it's going to give you 9% return. Okay, is that okay? Now, if it is 10-year bond, it is going to give you 6.17%. अगर ये 10 साल का बॉन्ड होता तो कितनी मिलती आपको? 6.7. अगर ये 5 साल का होता तो 3.9. अगर ये 3 साल का बॉन्ड होता तो 2.58. अगर ये 2 साल का होता 1.5. So as we go down the duration, it is not that, it is not very sensitive to the interest. As we go down the duration, the rise in capital appreciation will be much higher if you invest in a long duration bond. But if you buy a 2-year bond, for example, if there is a low duration bond, it will give you 1.78 plus the coupon rate in the year when the interest rates come down. Now it can just be the reverse here. Now think about, the bond the rate was 9%, okay, 20-year bond, but now the rate has gone up to 10%. Rate goes to 10%, your bond price when you check in the market will be 91.49. Now there will be some desperate people who want to sell the bond. They bought it at 100, they can exit the bond at 91 from the stock market if they want. Okay. Now banks, they invest heavily in these bonds, okay, as per the government regulation. So they're holding lots of money into these bonds. Okay. Now they have to tell, they have to declare how many bonds they're holding till maturity and how many they are, holding for only selling as an investment. Okay. Suppose they say, we are holding everything for sale. We are not going to hold till maturity. So they have to book their losses in their balance sheet as per the accounting standards. अगर लॉस हो गया दिखाना पड़ेगा, फायदा हो गया तो दिखाना पड़ेगा, नहीं हुआ तो नहीं. अगर आपने बोला कि मैं इसको होल्ड करूंगा मैच्योरिटी तक, तो आप अकाउंटिंग स्टैंडर्ड से बाहर हो जाते हो because you are going to have no loss or gain because of this market, up and down. Now there was a bank which failed, collapsed last year. What is the name of the bank? S से नाम था ना? नहीं, for American bank, Silicon Valley Bank. Now, what it had done was, it had a lot of money, was invested in these funds. A lot of, startup companies, they came and put the money into Silicon Valley Bank. Okay. And at that time, the Fed has been raising the interest rate. You might have heard that. Almost it was a 0% rate of interest about 7, 8 years, 10 years back. The interest rate has gone up to 4.5%. Even in America, the rate of interest is going up, inflation is going up. So the interest rates have gone up by 5%. Their Federal Reserve Bank have raised the interest rate from 0 to 5. What has happened? The bond market has collapsed there. The banks who were holding these bonds, like Silicon Valley, they had taken almost like 100 billions of money from the startups and invested in government bond. They thought it was very safe, and they had intention to hold to maturity, but they had invested almost everything in bonds. Now the situation changed after 4 years. All the startups, they needed money. They went to the bank and says, "Ki hame paisa do." So they had to sell these bonds, and these bonds are trading at 30% discount to its face value. And they started selling, and the news spread, and startup companies lined up for their money, and the bank collapsed. Bank had to close down their shop because if they sold all the bonds, their whole capital would have wiped off, and the bank would have collapsed. So then the Federal Reserve or maybe the government rescued the bank. Somebody bought it. Okay, so that is the reason for this collapse. Okay, so now we come to this. So there is a change of interest rate from 9 to 10%. The bond, you will lose 8.5%. Now a 10-year bond, you will lose only 6%. If you're holding 5-year bond, you're going to lose only 3%. If you're having a 3-year, you're going to lose at 2.5%. If you're 2-year bond, then you're going to lose. So the bond which is having a lowest in the maturity period is going to suffer the least loss. Okay. So that's why there are risks involved in investing in bonds. If the interest rates go up and down, the bond prices can go up and down. Similarly, the mutual funds who are holding these bonds, they have to declare their NAV based on the price of these bonds. जो प्राइस है उसके हिसाब से वो एनएवी कैलकुलेट करते हैं. सो आइदर द एनएवी इज गोइंग अप और डाउन डिपेंडिंग अपॉन द इंटरेस्ट रेट्स सिनेरियो. ओके, नाउ आई टेल यू द इंपॉर्टेंट कंसेप्ट, Macaulay's duration, because it's a duration. Here we are talking maturity period. It's a duration which is more important, and there are two concepts, Macaulay duration and modified duration. Now what is the Macaulay duration? Suppose there is a bond of 100 rupees. It is carrying suppose 25% rate of interest. For assume, for a very simple reason, 25% आपको कूपन रेट मिल रहा है. 100 रुपए का बॉन्ड है, 10 साल का बॉन्ड है. सो पहले साल कितना मिलेगा? 25 रुपए. सेकेंड ईयर 25, थर्ड ईयर 25, चौथे साल 25. जो आपने 100 रुपीज लगाया था, you have recovered all the amount in 4 years, isn't it? But you can't add up 25 lakh because there is always a time value of money. Because as we go down in the fourth year, what I am getting 25 rupees not equivalent to 25 today. So somewhere in between 4 years and 5 years, I'm going to recover my 100% of the money, isn't it? And that time frame, which is around say 4.5 years, is called the Macaulay duration. Okay, there's a formula I'm going to show. Okay, and you can just work out. You can calculate the Macaulay duration. It is not dependent upon the number of years. It is dependent how much period you are going to recover your principal back, what you have invested at the time of investing the bond. Okay, and here it is. So iska concept hai, modified duration is a concept which will be very, very interesting for you, which is an extension of Macaulay duration. Okay, so now let's take about the 20-year bond. Okay, just look at your screen. You bought this bond. Suppose this is a 20-year bond. It started in August, 15th of August 2002. I'll just put a date here arbitrarily. Maturity date is 14th August 2040. 20-year bond ho gaya? Okay. Now I just put my cursor here, and you can do along with me. Go to formulas, okay, and pick up Macaulay's duration, M duration. Go to financials and you'll get Macaulay duration. Ye aa gayi. Okay. Now put this settlement date here, and maturity, put this maturity here, and put the coupon rate, which is 9%. Put the yield, which is 10%, because now the interest rate is 10%. It has gone up. Okay, and frequency, put 1. Because one means after one, this is a bond which is giving you interest after 1 year. If the bond is giving you interest after, in half yearly basis, put 2. Otherwise, normally a bond gives you every year. So one would be normally the choice, okay? And then press here. So you will get 8 point, अच्छा सॉरी, अभी 8 पॉइंट ये आया था नीचे वाला, यहां से मैच कर गया ये वाला जो है. This is called the modified duration. Macaulay duration is, I go to Macaulay's duration, which is duration, sorry. Duration is the Macaulay duration. हाँ, अभी मैं क्या कर रहा हूं, इसको हटा देता हूं. पहले हटा देते हैं, पहले हम करते हैं Macaulay duration. तो ड्यूरेशन देखेंगे हम, तो हम जाएंगे इसमें गो टू ड्यूरेशन. सो देयर आर 2 टैब्स हियर, ड्यूरेशन एंड Macaulay duration. आई एम पुटिंग ड्यूरेशन, ओके. आपके वो उसमें मिल जाएगा, फॉर्मूलाज में मिल जाएगा. तो आई पुट सेटलमेंट हेयर, okay, I put maturity here, I put the coupon rate, I'm just selecting this, okay, I'm putting yield here, okay, and frequency 1. So I get 9.53. So here it's a 20-year bond, but duration, Macaulay duration is 9.53. Is that okay? Fine. Higher the Macaulay duration, more riskier with the bond. अब वो कूपन रेट पे भी बड़ा, अगर कूपन 10% होता, तो Macaulay अगर जितना कम होगा तो Macaulay duration जो है बढ़ती चली जाएगी ना. Coupon rate was 25%. I took it paid you money in 4 years. Okay, fine. So Macaulay duration will not going to be exactly as maturity period. Remember that. Okay, but now this is the duration. Now the most important and the most interesting part is now calculate modified duration. I'm going to tell what it is. Go to modified duration and put all the numbers which I put. Coupon rate is 9, yield is 10, frequency is 1. 8.66. So duration is 9 point, Macaulay duration is how much? 8.66. So this is very important. What it says, if there is a 1% change in interest rate, this bond is going to affect by 8.66. Look at this, very close to that number, 8.5. 1% change in interest rate and the fund has reacted by 8.6. Okay, so the modified duration, if it is given, it will tell you how this bond is. Because when you are seeing the bonds, you don't know कि 1% change होने से कितना percent change होगा. So look at the modified duration. It will tell you that 1% change can affect your portfolio how much. Either it can go up or go down. If the interest rate go down, the price of the bond will go up by 8.6. So we can just do it for the positive side also here. यहाँ देखिए आप, here the modified duration of a 20 year is 9.6. So look at this, 9.82. Okay. Now there is always a difference. I'll explain you the difference. It is giving you 9.82%. The bond price have gone up, whereas the duration is telling you 9.6. Isn't it? पहले ही समझ में आ गया आपको? This modified duration will tell you how much sensitive the bond is to the interest rate, because the interest rates can either increase your face value of the bond and give you higher return on that fund which you're holding. Okay. So this, if you're holding a bond which modified duration 9 points, is very risky. If you calculate a modified duration of a 1 year paper, it will be very less. Okay. Normally we should be unless there is a site which tells you 1 year down the line or 2 years down the line what will be the interest rate prevailing in India. Suppose today it is say 6%, for example. It says go to 5%. Then go and invest in long duration bonds. If you believe in that site, it's a good site which is telling you the interest rates are going to go down. But if it says the interest rates are going to go up, then invest in short duration bonds or liquid funds or short duration. Okay. So there is a projection given in the international site which tells you for all the countries what is the interest rate scenario prevailing in the world and how the interest rates are going to. I'll share that site, that link to on the WhatsApp group, and they will share with you. So you can just know what is the future trajectory of interest rates. Based on that, you will make a decision of putting your money in which country. Then Stay away from bonds, invest into liquid or low duration bonds at the most. हाँ, अभी हमने देखा था जब इन्होंने पूछा था, हाँ अभी इंटरेस्ट रेट ने जो है नीचे आने की है, अभी ऊपर भी जाते हैं नीचे भी जाते हैं. You know, all these sites are saying the interest rates are going to go down. Overall, the interest rates are going to fall, okay, in the next 1 year. But because of the Hamas and Israel war, जब यूक्रेन खत्म हो रही थी, मतलब वॉर तो चल रही है, बट उसका खत्म होने के बाद इंटरेस्ट रेट स्टार्टेड कमिंग डाउन. But then I'll show you the trajectory of interest rate. I'll show you the 10-year paper which tells you where the interests are going up and down, up and down. So हमारा रेट खत्म हो जाएगी इजराइल की या डाई डाउन हो जाएगा, इंटरेस्ट रेट्स आर गोइंग टू फॉल. ओके, सो ओके, see, always advisable. If you go and check in the site there, you will find there are only 5 funds long duration or 4 funds in long duration, and low duration there are 40 funds. So you can see, there are very few schemes which are on long duration. And I'll just show you, हाँ, yeah, I'll just show you one thing, okay? एक बड़ा इंटरेस्टिंग है. सी, अब मैं आपको एक चीज दिखाता हूँ इसमें. हाँ, अभी बस एक चीज दिखा के मेरा क्वेश्चन आपको देता हूँ. So, read this, Colonel Sahab, just read this. This was in 2007 when there was a financial meltdown in America. Just read.
For example, Vanguard's extended duration treasury ETF holds nothing but treasury bonds, but with an average duration of 27 years. It's extremely high risk. When interest rates crashed in 2008, the fund put up a positive 55% return. Then in 2009, when rates came back up, it had a negative annual return of almost 37%.
So these, I mean, the duration of these funds in America was 27 years, okay? And when the interest rate started going down after the crash, I mean, at the time of crash, the interest rate collapsed. So it has given 55% return to the people who are holding these bonds. But when immediately after the meltdown was over, and then, it gave a negative return of 37%. Now you can just look at this. So this is a 30-year bond, this is a 10-year bond, and 2-year bond, okay? Fine. So this is the the coupon rate, and these are the prices. Okay. So this tells you the same thing which I. हाँ जी, क्या क्वेश्चन था आपका? हाँ, रिटर्न दे दिया था when the interest rate came crashing down. हाँ हाँ, काफी लोगों ने बेच दिया हुआ. हाँ, वो परेशान थे, उन्होंने निकल के. Absolutely. When the stock market was not doing well, people made money in the bond market that time. Okay. Okay, is that clear? Any questions? I was thinking कि अब मैं क्या पढ़ूं, पर मुझे दिमाग में आया, भूल गया मैं चीज. आगे की जो फ्लो थी, I just lost. हाँ, ETFs, yeah. ETFs. हाँ, stocks and ETFs, okay. So पहले हम करते हैं म्यूचुअल फंड्स के ETFs, then the stocks. Okay. Exchange traded funds. Okay, now the funds which you buy, they are not listed in the stock exchange, except if it's a close-ended fund. Then the RBI or SEBI says that these funds should be listed in the stock exchange. But there are very few funds which are listed in the stock exchange. Okay, to just start with. हाँ बस खत्म कर देंगे हम 5 मिनट्स चलो 5 मिनट्स ब्रेक इवन आई नीड अ ब्रेक ओके 5 मिनट्स ब्रेक ये भी मैं शेयर कर चुका हूँ इसका नाम है म्यूचुअल फंड्स हाँ मेक एन so we are going to do only up to 12:50 we are going to close it okay
Okay, Mr. has shared the SOP for the placement committee on the all requested to kindly go through it and confirm that they read it. We are not asking for comments because we have gone through a number of variables in this. We've done a lot of process.